And the fact of the matter there that we've got a very large travel business in Australia, Flight Centre, which has traditionally not been an online business. Is it looking at, say, what happened to the Age or Fairfax vis-a-vis the Rivers of Gold classifieds? Is it looking at those companies and deciding to get more serious with its online strategy?
I think Flight Centre has a tough issue at hand. It has to decide how to, in the one hand, not alienate its franchisees through the traditional street vendors, and at the same time how to pursue a proactive internet strategy, because there is definitely a structural change in the way that airline tickets are purchased. If we're looking at the Generation Y, they are increasingly comfortable at purchasing airline tickets through an internet interface. They're not going into a Flight Centre store to purchase tickets. So Flight Centre has to, I guess, deal with that sort of two pulling powers there and determine a coherent internet strategy. And at the moment, we don't see that, and that's beneficial for Webjet because they are still gaining market share.
Tim Morris at Wiseowl. What about international companies like Azuji coming in, Hotels.com? You were mentioning that that's the kind of area where some of these Australian-based web businesses have been enjoying good times, but the market abhors a vacuum in terms of just leaving people to enjoy a good time.
Yeah, look, the platform there is wide open for all these competitors to come in, and they are starting to ramp up advertising, which does drive their market share and could threaten the local contenders. I mean, but with regards to Flight Centre, I don't see the balance of risks as affecting them so much because they concentrate on bigger ticket travel items, whereas the online operators, they're trying to, where they have gained market share is in mainly short-term domestic fares and so forth. I know from personal experience trying to hop on these airline websites and trying to book a big travel ticket overseas and so forth, it's very difficult still, and the services that Flight Centre offers are very relevant in the current climate, and that's indicative in their recent record profit. And now that the company is starting to enhance its online strategy, I see them quelling the nibbling ankle biters, which have been the local internet stocks that have stolen some market share.
Does What If have pricing power?
I don't think so. I think the barriers to entry are too low and there's too much competition.
Now, back to Rob Hopkins at Smallco, talking about the fact of the matter being that we don't yet have anywhere near the kinds of revenue online in some of these businesses that for example, in the US has, and we follow that experience with a couple of years' delay. Does that mean that the big businesses based on the web like Seek and car sales and realestate.com.au are nowhere near full penetration?
Yes, that's what I'd believe. Their penetration is relatively high, but getting that revenue has been taking time. So part of it is that the newspapers are still the dominant ground for display advertising. And so while someone like car sales has been very successful on getting the individual car ads online, they haven't been successful in coming out with a competitive product to the reviews that the newspapers produce for free as inserts. But you have seen them starting to do that, and certainly in their last result, their display advertising increased 40%. And going forwards, I think that will be the major growth area for them, in that they will become much better at getting display advertising onto the internet and commercialising that. So, for instance, they recently allowed Toyota to take over their website so that when you logged on to carsales.com.au, you got while you can still do the traditional car sales search, a large part of the website was ads for Toyota, and it had links to various different Toyota models. And for that service, they were paid several $100,000 over a fairly short period of time. And going forwards, I think you'll just see a lot more of that.
So there's still definitely growth stocks in the classic sense.
Oh, absolutely, absolutely. And the other great thing about them is that their cost structures are relatively low. To increase their size, yes, they do have some personnel costs, but on top of that, all they have to do is buy a few more computers. They don't have to go and build new printing presses the way Fairfax has had to. So it's a relatively cheap expansion, and their return on funds employed is just huge.
Now, Tim Morris at Wiseowl, of course, the web-based businesses, that's when we talk about internet stocks, that's not the only kind of stock we're talking about. There's also other kinds of stocks, such as the internet services providers, and probably prime among those would be TPG and IINet on the Australian Exchange. How do you see them faring?
Look, it's another story of heightening competition led by Telstra with its offer of more bandwidth and price discounting. And these telco stocks, they've had a good run during 2009 in the bear market recovery, and they led the way. But I think Telstra's decision to put its foot on recent customer losses will make it difficult for a lot of these strong growers of recent years to keep on increasing their profits without substantially higher risk. So at this stage, while a lot of them like Macquarie Telecom, TPG and IINet have a good track record of growth, the risks in 2010 have increased with market leader Telstra engaging in a price war.
And what does the prospect of the national broadband network do to that outlook?
I don't think it assists. It lowers the competitive barriers to entry and Telstra's strong market position, but I think the price war that Telstra is engaging is the most prominent risk at the moment.
Carlos Gill at Microequities, what's your view on the internet service providers?
I think one of the companies there that's more exposed to a competitive reaction from Telstra is TPG. TPG is its call to market, if you like, is an aggressive price policy, and they've been gaining a lot of customers from Telstra. So the fact that Telstra is becoming more price competitive, you'd have to question whether the customer acquisition rate of growth of TPG is sustainable. IINet's a little bit different because IINet has made a very significant acquisition in the AAPT business, which, depending on how well it's executed, could provide IINet with very strong growth. But obviously there's execution risks there, though we have to say that IINet does have a good track record of bedding down businesses, and they have gone through this process many times before. So there are systems in place and a management team that deals with acquisitions.
Any of those smaller internet service providers catch your eye, Carlos?
I think one of the companies, it's not necessarily an internet service provider, but one of the companies that I think over the long term will benefit from the NBN is M2 Telecommunications. M2 does not have a telecommunications network, so when the NBN comes, everybody essentially will become resellers of telecommunication services, and that is something that M2 is actually proven to be very, very good at. They are essentially a sales machine, and we can see in a post-NBN world, M2 gaining significant market share from other players.
Tim Morris at Wiseowl, you were mentioning that Macquarie Telecom also is worth looking at.
Well, yeah, we picked it at just under $2 last year. We've taken profits. It's become a lot more liquid over the last year with Hunter Hall reducing its significant shareholding, but it's got a very good record of EBITDA growth over recent years, and it's recently become profitable. It's debt-free, and it generates a lot of free cash flow, which is which is my primary attraction to the stock. But it's been outperforming despite the recent price war, so things are looking pretty good for it.
Rob Hopkins at Smallco. Rob, any interest for your firm in the ISP area of the market?
No, I think that Carlos and Tim have summed up the situation there very well, in that it's just very competitive with the guerrilla Telstra deciding that they want to regain some market share and putting pricing pressure on, and combine that with the fact that the ISPs have to keep on buying DSLAMs in the exchanges to expand their networks, so they have quite a high capital expenditure. I think it's a very tough road for the ISPs over the next, the next year or two.
Back to Carlos Gill at Microequities, because I wanted to ask you, Carlos, Melbourne IT is a stock that a lot of people seem to find a great degree of difficulty in adequately categorising what that company does. What's your view of it?
Well, Melbourne IT is a composite of different businesses. They've got a digital brands business. They've got a web hosting business, which they acquired from Web Central. They've got a traditional domain registry and retail internet service provider. So there's a whole sort of composite of businesses, and Melbourne IT is kind of like a holding company of those different business interests.
So it's not an internet stock in terms of having an online business model, but there's internet exposure there.
It does through its digital brand management business. It does have direct exposure to that, and also from the corporate and enterprise web hosting side of their business.
Tim, any interest in Melbourne IT, or does its diversified model work against it?
Look, this stock is very interesting at the moment because it's trading on a single-digit PE ratio and almost a double-digit dividend yield, so it attracts a lot of value investors. But its share price has been very weak since topping out in 2007. It's less than half of its all-time high, and I think that's because there are questions over whether it can continue to generate the earnings per share growth which it became accustomed to in the first half of the decade. And so I'm keeping a watchful eye on it, but we're not recommending it at this stage.
And back to Rob Hopkins at Smallco. Rob, when we were talking for the article, your view was that while there's some very big web-based businesses in Australia, the ones we've been talking about that have become very successful and become billion-dollar stocks, you were looking out into the future at an interesting stock operating in Asia that could do some of the same sort of things.
That's right. So IPGA has successfully got itself the number one position in real estate in Singapore, Malaysia and the Philippines. It's equal number one in Singapore, but in the other markets it is the number one player, and those markets are very immature and still very much paper-based, so not a lot of their business is online, but certainly going forward you would expect that a lot more of that will come online, and it should in the long term become a very profitable and successful business.
And Tim Morris, you had an interesting view that even if the internet service providers are beset by competition, look beyond them to the service providers.
Yeah, certainly the guys who are providing all the labour and the skills to construct the NBN and so forth, IT service companies like SMS Management and Technology is our top pick at the moment. These guys also generate very strong free cash flows and are trading on relatively modest trading multiples compared to their record of earnings growth. And the outlook is fairly promising, with the primary risk being labour. Can they get the hands on deck to supply the demand that there is at the moment?
Okay, that's all we'll have time for this afternoon. I really would like to thank my guests, Rob Hopkins, co-founder of Small Cap Specialist, Smallco Investment Manager, Tim Morris, Senior Analyst at independent research and advisory house Wise Owl, and Carlos Gill, who's Managing Director of Specialist Microcap Fund Manager and Researcher, Microequities. Thank you very much for your time, gentlemen, and thanks for listening, everybody. We'll be back next Wednesday at 2 p.m. with another in the series of the Vanguard Wednesday Wealth Forum series. Thank you.